Hi everyone, I'm Mark Searle. I'm a senior consultant here at XPS Investment. I'm going to spend a few minutes talking through what's happened in markets during the second quarter of 2021. Major equity indices closed out the quarter at or near record highs, following a June rally powered by technology stocks. There was a raft of positive economic data, including the Organisation of Economic Cooperation and Development revising its economic growth forecast for 2021 up from 4.2% to 5.8%. There was further evidence that the global recovery is uneven, with the OECD noting signs of a more rapid recovery in the economies of those nations who dealt with COVID more effectively and who are further on with their vaccination programs. Equity markets managed to shrug off concerns over new COVID variants, particularly the emergence of the Delta variant. The global vaccine rollout continued with further evidence of vaccines' effectiveness. April and June saw strong gains, but concerns over the prospects of increasing inflation, a tighter labour market, and increasing input costs led to a sharp sell-off mid-May. The US Federal Reserve sought to reassure investors that inflationary pressures were likely to be temporary and that it would maintain its accommodative monetary policy stance. While the Fed held rates stable following its June meeting, the big surprise was in the Fed signalling through its now infamous DOTS interest rate projections. These indicated an expected 2 rate hikes of 0.25% by the end of 2023, whereas previous guidance had been for no hikes until 2024. Economists expect the UK economy to bounce back to its pre-COVID level by the end of the year. The headline unemployment rate fell for the fourth consecutive month to 4.7% in the 3 months to April, in line with expectations. Consumer price inflation hit a 2-year high of 2.1% in the year to May, above the Bank of England's 2% target, with transport costs being the largest contributor. The bank expects inflation to run above 3% in the near term as the UK economy reopens, but then ultimately settle closer to its target in the medium term. Both fixed interest and index-linked gilt yields fell moderately over the quarter, albeit following significant rises over the previous quarter. Sterling investment-grade corporate bonds produced positive returns, driven by this fall in gilt yields, with the credit spread, or the additional return on corporate bonds compared with similar gilts, remaining stable at compressed levels. Investment-grade corporate bonds outperforms high-yield corporate bonds, predominantly due to the lesser impact of gilt yields on high-yield bonds, given they have a shorter maturity on average. We expect the funding level of a typical UK pension scheme to have improved over the quarter, with strong growth asset returns more than offsetting the higher value placed on liabilities due to lower gilt yields. I hope this update has given you a clear review of the key movements in markets over the quarter. For more information on this and other pension scheme investment issues, please see our website.